Hold on to your portfolios because SCHD just dropped like a rock, and the numbers I'm about to share might shock you, but they shouldn't. Picture this. While you were watching SCHD slide 3.2% this month, the S&P 500 was quietly climbing 3% higher. And here's the real kicker. Those flashy growth stocks? SCHG just posted a stunning 7.38% gain, while Palantir rocketed up an eye-watering 24%. I can already see the panic selling in the comments section, but before you rush to dump your SCHD positions, let me show you why this might be the exact wrong time to abandon ship. I'm seeing floods of messages from worried investors. Should I sell SCHD and go all in on AI stocks? Is value investing dead? Here's the truth about what's really happening with SCHD and why these market movements might be exactly what smart investors have been waiting for. Because while everyone's chasing the latest AI hype train, you might be missing the bigger picture that's forming right beneath the surface. Think about it. In a market where everyone's sprinting toward the same shiny tech stocks, could this SCHD pullback be setting up one of the most overlooked opportunities of 2025? Let's dive into the real numbers, strip away the market noise, and look at why some of the biggest institutional investors might be quietly taking positions while retail investors panic. What I'm about to share isn't just analysis. It's a blueprint for understanding how to turn market fear into your biggest advantage. Now, before you start panic selling your SCHD positions because some TikTok influencer told you to go all in on AI stocks, let's have a real talk about what you're actually invested in. And I mean really invested in. Because here's what's wild. I'm seeing comments like, I bought SCHD 2 weeks ago and it's not mooning yet. Seriously? That's like buying a blue-chip dividend aristocrat and expecting it to pull a Palantir-style 24% monthly gain. Look, I'm about to drop some truth bombs here, and yes, I woke up and chose financial violence today. SCHD isn't your high-flying tech stock. It's your portfolio's steady backbone, designed to be your voice of reason when everything else goes crazy. Let's put this in perspective. While everyone's chasing the next AI rocket ship, SCHD is quietly delivering something remarkable. A solid 9% year-to-date appreciation. Add in that juicy 3.31% dividend yield, and we're talking about a total return of 12.31%. Let me break that down into real money. If you're putting just $500 monthly into SCHD, staying consistent for 20 years at this rate, even in what people are calling its worst year, you're looking at building a $450,000 nest egg. That's not counting dividend reinvestment, which could push those numbers even higher. Still think that's boring? Here's what makes SCHD different. It's what I call your portfolio's shock absorber. While your Nvidia and Tesla positions are doing their roller coaster impressions, SCHD is steadily doing its job. It's the financial equivalent of having insurance. You don't appreciate it until you really need it. And trust me, in my years of investing, I've seen enough market cycles to know that everyone becomes a genius in a bull market, but it's the bear markets that separate the investors from the speculators. Now, let's talk about why SCHD is actually dropping, because this is where things get really interesting for smart investors. First off, SCHD isn't alone in this dance. Look at VTV, Vanguard's value ETF, down 1.42% this month. And VYM, SCHD's cousin in the dividend space? Same story. But here's where the real money story unfolds. Think about what's happening with treasury rates right now. We've got high-yield savings accounts throwing out 4 to 5% returns with virtually zero risk. It's like finding money in your couch cushions, safe, easy, and guaranteed. So naturally, some conservative investors are parking their cash there temporarily. But here's the thing. Those rates won't stay high forever. And when they drop, guess where that money's going to flow? Right into quality dividend funds like SCHD. Let's look under SCHD's hood for a minute. The top holdings tell us everything we need to know about why this temporary dip is happening. Home Depot, trading flat. Bristol Myers, down 1.64%. Chevron, taking a 7% hit. But here's the beautiful part. These aren't speculative tech startups. These are revenue-generating giants with proven track records through multiple market cycles. Compare this to what's happening in the tech space. Nvidia's up an astronomical 167% year-to-date. And while that's impressive, let me ask you something. Would you rather buy a stock after it's gone up 167%? Or buy quality companies while they're on sale? Because that's exactly what SCHD is offering right now. A Black Friday sale on some of the market's strongest dividend payers. And here's the part that most investors miss. SCHD's 12-year track record of consecutive dividend growth, with a 5-year growth rate of 12%. In other words, while tech stocks are doing their best roller coaster impression, SCHD is quietly growing its dividend payments year after year. Forbes just highlighted this, calling SCHD an exceptionally well-diversified mix of top-rated dividend stocks with an impressively low expense ratio. So let's talk strategy for 2025, because this is where you can really turn this temporary SCHD dip into a massive long-term advantage. I'm about to share exactly what I'm doing with my own portfolio, and why these price levels have me seriously excited about building wealth over the next decade. First, let's be crystal clear about the numbers that matter. When SCHD delivers a 12.31% total return, 9% appreciation plus that 3.31% dividend, in what everyone's calling a bad year, imagine what happens when market sentiment shifts back to value stocks. And trust me, it always does. Always. Look at the last 2 decades of market cycles. Quality dividend stocks have historically caught up and often surpassed growth stocks during market rotations. Here's my personal game plan, and why I'm actually increasing my SCHD position. I'm maintaining my consistent dollar-cost averaging strategy every single month through 2025. But here's where it gets interesting. I'm treating these dips like a sale at my favorite store. When SCHD drops below $26, that's my trigger to double down on my regular investment amount. Why? Because at these levels, we're essentially buying companies like Home Depot, BMY, and Chevron at a discount, while they're still printing money and increasing their dividends. Think about the mathematics of wealth building here. Every time SCHD pays that dividend and you reinvest it, you're buying more shares at these discounted prices. It's like getting a bonus coupon on top of an already great sale. And remember that 12-year track record of growing dividends at a 12% 5-year growth rate. That's the kind of compound growth that turns modest monthly investments into substantial wealth over time. Let me put this in perspective. If you're investing $500 monthly in SCHD, reinvesting dividends, and the fund maintains even close to its historical performance, you're not just building wealth. You're creating a growing income stream that could eventually replace your salary. That's real financial freedom, not just paper gains that could vanish in the next tech sell-off. Look, I need you to understand something crucial about building real, lasting wealth in 2024 and beyond. While everyone's getting caught up in the AI hype and panic selling their SCHD positions, smart money is quietly accumulating. This isn't just about holding through a dip. It's about recognizing a generational opportunity to build serious wealth through dividend growth investing. Let me be crystal clear about my 2025 investment strategy. I'm not just holding SCHD, I'm actively increasing my positions. Every single month, like clockwork, I'm dollar cost averaging into SCHD. When it dips below $26, that's not panic time, that's buying time. Because here's what the data shows us. SCHD isn't just a dividend fund, it's a wealth compounding machine with a 12-year track record of growing those dividend payments. Think about the power of what's happening here. While growth stocks are bouncing around like a sugar-rushed toddler, SCHD is quietly building your wealth in 3 ways. Price appreciation, 9% this year even in a down period. Growing dividend payments, 3.31% yield. Dividend reinvestment compounding your returns. That $450,000 projection I mentioned earlier? That's not a fantasy. It's basic math based on SCHD's actual historical performance. And remember, this is during what everyone's calling a bad year for the fund. Here's your action plan. Keep your regular monthly investments consistent. Use these dips as buying opportunities. Reinvest those dividends automatically. Maintain your balanced portfolio strategy. Stop checking the price every day. Think in decades, not days. Remember, investing isn't about catching every market surge. It's about building sustainable, growing wealth over time. SCHD isn't dropping like a rock. It's giving you a rare opportunity to buy quality at a discount. The question isn't whether you should sell. It's how much more you should be buying at these levels. If you found this analysis helpful, make sure to hit that subscribe button and notification bell. We'll be doing deep dives into portfolio construction and dividend growth strategies all through 2025. And drop a comment below. Let me know if you're buying this dip or waiting on the sidelines. Until next time, keep investing, stay rational, and remember, wealth isn't built overnight, but it is built systematically through smart, consistent investing in quality assets like SCHD.